the breakout, gold's going to make a new all-time highs.
Gold-backed ETFs seen inflows of over $5 billion.
$0.8 trillion gold market.
Why are we the only guys that seem to understand this?
All right, everyone, welcome to Live from the Vault. My name is Shane Moran, and I will be your host. And what an exciting show we have for you today. Lots of movement. I know lots of questions coming in. And so with that, let's go over to Andy back from Switzerland and Liechtenstein, and now back in the UK. But hey, Andy, welcome to the show, and maybe tell us a little bit about what the updates are from Liechtenstein.
Yeah, great. Nice to be with you again, Shane. And yeah, let's have a quick review of that, because this is the most exciting thing. I think one of the big excitements that I see for Kinesis. We've just I went there really to one of the primary goals was there to open up our brand new vaulting facility. Now this is a state-of-the-art 7,000 square foot facility, which I mean there is some art and stuff stored in the upper floors, but essentially Kinesis has opened up the only office in this vault. Has opened up our silver storage facilities there, gold storage facilities there, and so we're going to have the Kinesis logo on the outside of this 7,000 square foot building. This is world class, and to be honest, I've been into many vaults in my time, but I've never seen such an amazing setup. This is, as I say, state of the art. And when I was there, we received 20 tons of silver, 1,000-ounce bars coming in, and just the way it was handled, it was just amazing to see. Normally, you're constricted. Space is limited. I mean, we're talking about acres of space here, and literally, as those bullion bars were counted in. They went into they were easy to bring in. Normally you get the European pallets come in with bars stacked on top of each other, and you can't read the serial numbers. You have to move these. These are all beautifully prepared for us. It's part of our mandate that they're prepared in such a way where we get the pallets come in with the bars just laid out. Particularly, nothing has to be moved. Serial numbers and the bar numbers are often now on the ends, and some are on the top, but which is an issue for if they're stacked on top of each other. But brilliant, absolutely brilliant. I'm so excited. The office there is world class too, and we're going to have that's going to be our global headquarters from now onwards. So that's really excited about it. Now, obviously, traveling to and from Liechtenstein at the moment. Liechtenstein has no lockdown measures, had no mask issues, no anything. I mean, in fact, there's just no problems over there. But traveling through Switzerland means you're locked down for 2 weeks. So essentially, when I get back, you're locked down for 2 weeks. It's not a problem. I mean, we operate as we operate here from our homes as well as our home offices, etc. So it's not an issue. And I'm sure it's the same for you, Shane. You're in an area where, goodness me, you're in Italy, and that is probably got stricter guidelines than probably we have over here.
Awesome. Well, I'm glad you had a great trip, and you seem fired up about the facilities down there in Liechtenstein. That's pretty exciting stuff. Let's get right into it this week, and I know a lot of people are going to be excited to hear your views on what's happening with gold.
Yeah, and this is good. I'm glad we're dealing with this because a lot of people, there's a lot of questions about this, and not surprisingly, because we know how tight bullion supply is. We know we can't get wholesale supply in the size we want in either gold or silver. So people say, well, why the hell is the price going down there? And so bottom line, and what we're witnessing is it's a defensive play now into this Friday's October auction expiry. And really what they're trying to do here is, because bear in mind, there's some bets being placed probably 10 months, 12 months ago, and up until now that said they don't really want, there's some huge bets. These are actually linked to large derivative bets too. And they need gold to settle below 1950 on Friday. But there's two sides to this story. And although what we've just witnessed this week and even today looks short-term bearish, it also has put the COMEX Achilles heel into the crosshairs. And I know this has been discussed. You really need this from a wholesale market view, and this is generally what we provide for our members. And look, I don't want to get too technical here either. Everything I say is really just summarizing, and believe me, there are a lot more nuances to this. But in summary, and we covered this at the time live on March the 23rd. The COMEX paper market broke. Okay, so we established that then, and we've talked about it since. But I think it's important to look at the big picture here. What broke was the paper to physical exchange for physical mechanism. So what we call the EFPs. Now, this is the conduit between the futures market and the 10 times larger over-the-counter markets, which are viewed as the physical delivery markets, and really where the gold and silver price fixes are set, as they were today, as they are every day. And this is done in London. Now, generally, trading houses run a largely long spot gold and silver book, but not all of this is one-to-one physical. In fact, very little of this is one-to-one physical. And what we're really discussing is, for gold, 100-to-1 fractionally physically backed long spot gold contract that is employed to hedge a position for their clients, which might be legitimate, or is largely the case, traders just simply seeking to scoop a small arbitrage profit in the non-delivery futures markets, which generally trade at a premium to spot, which they should if everything's balanced. Now, so this EFP fracture was instigated by a massive short squeeze in futures, exposing hundreds of tons of underwater gold spot positions which were being demanded for delivery. Now, the last thing a trading house that is just trading 100-to-1 leveraged spot gold contracts, the last thing they want is to be asked for actual delivery. They don't have this. It is a paper contract until they're asked for delivery. Now, if they are asked for delivery, what they need to do is square up that position to get off the hook. That's essentially what happened. And this is what we evidenced into the March sell-off attempt. And the reason I bring this up now, though, and today, is that the current sell-off that we're witnessing in gold and silver is evidencing very similar footprints. This is actually quite bullish. Now, what we are evidencing is very similar tonnage size spot index buying, and only this buying is coming in from a $400 higher stair step in GC. We call the proxy for gold is, of course, futures is GC, and actually is coming in $10 higher at a $10 higher stair step in SI, which is the silver futures contract. So, but just like in March, with gold back in the 1400s and silver in the 12s, this spot indexing position will once again be demanded for delivery. Now, that's regardless of a rising price. And spot indexing means if I buy gold at 1900 and it happens to go up to 2500, I don't care because I've locked in the price. And when it's delivered to me, whoever has to buy it at 2500 to give it to me has to do that. I simply own that contract. So really, that's kind of how spot indexing works. Now, to give an idea of why a spot index position can fly under the radar is, until it's demanded for delivery, that is out of 1,000 tons of paper gold cleared every day in London, really only 3 to 5 tons of gold are ever physically delivered out of that 1,000 tons. Now, this is so really you can start to see, well, okay, so when a paper spot index gold position is demanded for delivery, it's not on the radar until the request is made, because so much of this volume is simply cleared across the books as people try to make an arbitrage profit. So if we fast forward to now, since March, we've witnessed a mad scramble to add back liquidity into the COMEX. Basically, the broken COMEX that no one trusted anymore after losing so much money. And believe me, a lot of European second-tier banks still suffering massive losses from the breakdown in that. And so we have a breakdown in trust. So what they're trying to do is scramble to provide liquidity back into the COMEX to keep it alive. And so we've seen scurry deals with the LBMA. I mean, this is a competitor. But they all have so much to lose when the paper market game collapses. So they've well, I say colluded. They've got together to save their bacons, which is, I mean, it's ultimately this paper market's going to fail. And we've already seen a break in the ranks with the likes of Goldman Sachs. We've seen the Bank of America. We saw Citi today coming out and saying, look, we even think $2,700 gold is before the election. I mean, these guys are all, I know from a wholesale market perspective, these guys are long physical and are getting longer physical every single day. And really are some of these are the major bullion houses are positioning themselves, not just long physical gold and silver for an inevitable gold price revaluation, which can only be resolved in the gold and silver foreign exchange markets, but they're also this is the very reason that they're spot indexing. But, you know, I promised you to tell you what is the Achilles heel. And this is the part which I think it's not out there, but essentially, if we look, and if you can look at this yourself, the expiring October contract, which is up for delivery on Friday, comes into delivery on Friday, in fact, goes into first notice day, it's backwardated by up to $6, meaning the futures price is cheaper than the 10 times larger delivery market in London. Now, this is a big deal because that is technically where the delivery market is. And so when you weigh this up against the December contract, which is trading at a $3 contango, which is a premium basically, but it's still a technical backwardation when you weigh in the cost to carry, the insurance costs, et cetera. So that's a very small premium for the spot cash market. So essentially what it does is put the October contract directly in the crosshairs for physical delivery demands. Now, this is not designed to be a delivery market. When the COMEX was contrived in 1974, right after the Nixon closed the dollar peg to gold in 1971, they needed a mechanism basically to control the gold price. And in fact, part of that control mechanism was to add as much paper supply as possible, and also to create volatility to really kind of put people off. But of course, this is now full circle. That game doesn't work anymore. And so really, what we're seeing now, we're hearing from two separate, very large first-tier trading banks who are now targeting the COMEX bars for delivery. Now, that's unheard of. And this is most unusual, as this October contract is usually glossed over. It's usually a non-event contract, with really everyone focusing on the December contract. And usually it has very little interest in there, what we call open interest. Well, it's around 30,000 contracts, it's over 60,000 contracts. Now, that is puzzling in the first instance. But when you think about it, with no tonnage size for physical gold available in the global wholesale market, we all look to the recently cobbled together COMEX market to call them on their claim that they have bullion to deliver. Now, immediately deliverable bullion that is unavailable at current prices anywhere else. Now, this is a catch-22 situation that COMEX did not envisage, and they're about to be raided for cheap bullion. So currently we're evidencing an additional 100 tons of positions held in this contract, which isn't normally there. And that's held by paper longs, like COMEX longs, who would ordinarily close those positions into a gained price release, which is really partly what this was all about. But they're not closing those positions. Everyone is standing for delivery. If you can't get the bullion, you have to go to where the bullion is. Now, with the current COMEX-driven backwardations still very cheap, even in December, versus what most liquidity providers consider to be hundreds of dollars under fair value. Gold futures, GC gold futures, will be demanded for immediate delivery, not just in October, but also in December. Now, just to put things in context, yeah, okay, we have to bring it over from the States back to Europe. It only costs 50 cents an ounce to ship bullion from the US to Europe, and it can go straight on a plane, on a passenger plane, and usually you can take up to 3 to 5 tons on a passenger plane, full insurance. So this is not an issue. So what we're saying is that by the CME rescuing the defaulting COMEX since March, the COMEX has inadvertently set itself up as a delivery market, and like it or not, they're going to be raided for physical. Now, the current futures market algo-driven price match, which is really what this is about, it's a 98% algo-driven market, and these algos seek to correlate on anything that might work, anything whatsoever, and they currently have correlated this to these the S&Ps. They've correlated it to the dollar index, and these things work until they don't work. But what it's done is by putting such these correlations should not exist, but this algo, the algos don't think. Essentially, what they're doing is just trying to find anything that works, and what that's done is dislocate the real foreign exchange price of gold, and this is going to be capitalized on. And the reason we're seeing such large open interest in October and spot index buying is to secure huge size. So bottom line, what I'm saying, guys, this, despite what you see in the short-term charts, is a very, very bullish setup for gold.
Hey, Andy, it really sounds like there's a battle going on between paper prices and the physical gold prices, but I'm so happy and grateful that here at Kinesis, we talk exclusively about physical gold and physical silver. Speaking of physical silver, Andy, is there a correlation in terms of what's happening with gold and maybe what people who are looking to invest or are invested in silver should be watching for during this time right now?
And Shane, I know you are a silver guy, and I know that for many years now. You're, in fact, one of the biggest silver guys that I've been dealing with for some years now. Now, yes, silver is a wholly different story, and this is an interesting too, and it kind of keys off the same issues, but it's different in this respect that, look, we already were 100% certain that JP Morgan had cornered the physical silver market, but what is really not known very well is that their position has stealthily evolved into a whole new level, and that commenced in March for exactly the same reason. What was trying to be achieved here was to bring back some credibility into what was a broken mechanism. Now, these footprints, JP Morgan's footprints, are disguised, but they become visible. Now, JP Morgan has successfully gained, and I'm absolutely sure this is accurate, they've gained full control of the largest physical stockpile that I can think of in history. And this is much, much larger than the Hunts. In fact, this is why there's no immediately deliverable wholesale size silver wholesale bars available, because it's all being front run in the US. And okay, and that's why we can't buy anything. And it's also clear that this predatory Fed agent bank, and we know that they are a primary dealer for the Fed. This is not conspiracy theory, it's a fact. We know that they're largely immune from prosecutions due to their federal government agency agreements. Now, obviously, I'm involved in the whistleblower cases, and you know that there's a lot of people now being charged. We actually saw some jail time being handed out at quite a senior level. But so really can't talk about, I'm not really at liberty to disclose all of the details, but with regard to the silver story, we were actually made separately aware that a major US-based trading house was given something that is unbelievable to me, an unlimited letter of credit to buy every ounce of silver available, including very attractive large EFP premiums offered to producers to sell their forward production. Now, hang on, we're talking about JP Morgan issuing this letter. Now, I'm sorry, it doesn't matter how well established you are. Shane, you would know this, and anyone in business would know this. Nobody, no matter how well established, would be given an unlimited letter of credit. I mean, you just wouldn't provide this to anybody to buy any asset at their discretion, and in this case, physical silver, and forwards and forward production as well at any price, their choice. Just get it. Now, and some of this stuff would have perhaps been bought, and I can't guarantee. All I know is the EFP premiums are running probably at 20, 30 cents, depending on how deeply discounted the market is, but essentially could be offered $1 or $2 above that price. That would incentivize a lot of people to, especially when you've rigged a bit of a downtrend and you phone up and you say, look, guys, you've got your production there. Look at the price going down. We think it's going to go down a bit more. I'll tell you what, why don't we just give you $2 over spot right now if you sell us 6 months, 12 months of supply. And obviously the temptation there is reduce the responsibilities to provide for it. There are reasons why you might do this. So essentially, we're talking about this is a real play that we've never seen before. So you just simply have to connect the dots though. Who the hell would give a taxpayer funded bank essentially who would give them an unlimited letter of credit to go ahead? It can only be the Fed. I mean, there is nobody else that could possibly issue such a letter. And really what we're seeing here is, look, we already know that the COMEX is an exchange that was put in place to really attempt to control the gold market without using physical. And so really silver has always been a big problem because silver is correlated to gold. Yes, we've seen the ratios go to ridiculous levels when in fact they should be probably closer to 15 to 1. But really what we're doing is we're saying, this is an attempt to really provide physical liquidity into the COMEX and in other words, become a physical exchange. And this also explains the exchange for physical spreads being so large and in all the silver contracts since March. I mean, and to me, you'll never see them drop below 10 cents. And that's not how it works. That's not how it should be working. So JP Morgan as a company will benefit from a silver price rise. So you think, okay, they're going to smash it. Well, okay. This predatory insider will seek to capitalize on this when people least expect it, though, while still fulfilling its role as a government agent bank. Now, they certainly are not selling any silver at current prices. So you look at the price today, is anything available? No. In the meantime, we see silver has built a base that attracted too many competitors. But with specs wrong-footed, this rally will commence, as I say, with the least specs on board. And the thing is, what we just discussed about gold, that also puts silver in the crosshairs. We can't get any silver. None of the people I deal with either can get any wholesale silver. Yeah, okay, we got 25 tons the other day. This is because there was a long lead time to get that. We are also T plus January, T plus February, T plus March to get size to fill orders for clients, which is ludicrous because when you think about it, if a bullion bank is supposed to have silver in their vaults, and you could call up JP Morgan in London, you say, well, you've got 300 tons of silver there. I'd like it, please. And it's not for sale. You say, well, hold on a minute. What's wrong here? It's not for sale at this price. That's what it is. So we now see the COMEX has sucked in physical silver. Where do you think we're going to get it? Yes, we will. And we'll go and we'll get, and silver costs a little bit more to ship, but essentially it's still there for us. So we're going to see a raid on the COMEX for silver as well. So really, but bottom line, look, if you rig prices below equitable supply-demand fundamentals, what it does is tighten up what little real bullion is on offer at market, which is, in other words, today's price. And what we do is it's immediately recognized by the wholesale market to just jump in and lock in cheap spot prices and ounces, not just ounces, tons at heavily unsustainable foreign exchange gold prices. So this is really the equation that determines the price support point. So what we have now is a lot of fiat chasing what little bullion is on offer, which further tightens supply, and the offer to sell bullion will rise to meet this demand. Now, given the enormous paper market leverage, this is having a lagging effect on the price, but ultimately fundamentals will drive this chart painted technicals higher. So in other words, really we're summing up and saying, in other words, how much wrong-footed non-delivery spec supply can be chart painted in with insiders taking the long side of each sale versus competitive real market forces who recognize gold and silver bullion as deeply undervalued and are locking in prices for physical delivery. That is where we are today. And that is why, yes, we see, and if you draw back and look at a bigger chart, this is not a big deal. What we're seeing is really a base building from a higher level for the next. And if you remember, we moved $10 higher in silver from March, and we're seeing the same kind of setup, but from at a $10 higher price. So really, we I would say, if you've got physical, you're not going to worry about this anymore. You're not going to sell it, nor is anyone selling it, outselling it, and nor any of the bullion banks selling it. Reluctantly, I mean, essentially, even the refiners that we deal with put silver aside and said, look, we can't even meet our gold demand. So, this is a ludicrous situation. And obviously, it's the paper guys that are the problem, i.e. if you are margined, you go and borrow money from a bank, a bullion bank, who's a market maker, and they can aggregate their book and say, oh, hold on a minute, look, we can get a hell of a lot of, and basically, you can get away with it in the sense that even though you have position concentration, if you hold a large physical store, then you can say, well, you can argue the fact, well, yeah, okay, well, I did sell 7,000, 8,500. Yes, it was over the position limit amount, but by the way, I've got it fully backed up with physical, so you can get around the rules to a certain degree. But each time you do that, what you're doing is actually digging a hole for yourself. So comes a point where the lines cross, where you can't take it down anymore, and the algos that are correlated right now, believe me, are out to lunch to try and correlate a contract as large as the S&Ps, to a tiny market like silver is why you're seeing this volatility, but why everyone else is jumping on that dollar-derived price and saying, bring it on, because we know this is just some crazy algo chasing stuff that they really shouldn't be involved in. And it will break. This will break. So I think my message to everyone is, of course, stick to your physical. And this is another reason why kinesis is close to my heart, because you can actually, instead of trading on the COMEX and taking, borrowing money and taking a risk to try and make a small amount of yield or a large amount of yield, well, you know what? You can do that by minting physical gold and physical silver in the kinesis ecosystem, and have it in your name on the blockchain, fully secure. And you know what? Why would you and create a yield that is likely to exceed anything you can possibly even ever make just by trading? Because you trade on this COMEX casino, casinos will let you win 5% of the time. They'll make you lose 95% of the time, unless you're an insider. So what we're trying to do is say, look, we'll give you the view which really says, look, okay, we can look at the bigger picture, and we can say, look, please don't be a part of this game. Don't be that punter in the casino that has that is chasing something where all you're doing is empowering the system. So I would say the only solution out there are probably 60, 70 gold coins out there. Not one of them, not one single one of them would allow you to participate in the actual ecosystem and get a return on each and every transaction. I know this is something really close to your heart, Shane, because you've done some amazing videos on this, little short videos that explain things to people. Even simpletons like me can understand your 3-minute videos.
Yeah, well, it's awesome. It's a great time to be in the industry. And one thing that I would challenge anyone watching this video is, and again, we're only talking about physical silver. Of course, we're comparing it to the paper and what's happening in the paper, but I can't find physical silver per ounce or per gram. So silver per ounce and gold per gram. I can't find it less expensive than I can find it on with Kinesis. So that's pretty exciting. And so any final thoughts for the next couple of weeks here until we come back and what we should be maybe looking for over the next couple of weeks?
I think what we should be looking for is if you're a stacker or you are in the physical market, take advantage of this. This is bargain territory. That even the major bullion banks, and I've got good contacts at a lot of these guys, with a lot of these desks, and I know what they're doing, and I can see their footprints in the wholesale market. These guys are fully already banking on at least 2,300 gold, and in some cases, $2,500 and $2,700 gold. So, yeah, and silver, the ratio. I mean, you just take $2,500 gold, you move to the natural ratio. In fact, it could even be 4-to-1. But I mean, let's just say even 16-to-1, $150 silver, and that's without even trying. So, physical, please, nothing but physical.
All right, Andy Maguire, thank you so much for that update. We always look forward to these gold and silver physical updates. And speaking of physical gold and silver, like I said, I have never been able to find in over 15 years where I could buy physical gold or silver for closer to spot price than the Kinesis monetary system. This is huge. All right. Now, in addition to that, imagine just for holding your gold or silver, you're getting a yield. That's the holder's yield. There are no warehouse, there's no fees for storage every single month like everyone else. There are no fees for storing your physical gold or silver. In addition to that, we now have the Kinesis Visa debit card that you can spend your physical gold and silver. And in addition to that, if that wasn't enough, if you know any person or company or government organization, you can send them your referral link and you'll receive a yield based on the transaction fees in that wallet forever. And so with that, that is it for this edition of Live from the Vault. And we will see you next time right here, live from the vault. Bye for now.